Most people believe banks simply take money from savers and lend it to borrowers. This sounds logical, safe, and responsible, but this is not how modern banking actually works. In reality, banks create most of the money we use every day. They do not need gold, cash, or savings first. They create money digitally, almost instantly. This process is often described as creating money out of thin air. The phrase sounds extreme, but it is technically accurate. And yes, it is completely legal. To understand this, we must forget the idea of physical cash. Today, most money exists only as numbers on screens. Money is nothing more than digital entries inside bank computers. When you deposit money in a bank, it does not sit safely in a vault. The bank records it as a liability on its balance sheet. At the same time, it prepares to lend much more. Now imagine you apply for a loan. The bank does not look for someone else's savings. It simply types new numbers into your account. The moment the loan is approved, new money appears. Your balance increases instantly. That money did not exist before this moment. This is called credit creation. Money is born as debt. At the same time, the bank records something else. Your loan becomes an asset for the bank. Your debt becomes their profit-generating product. This is the core secret of the banking system. Money and debt are created together. They are two sides of the same transaction. This system is known as fractional reserve banking. Banks are required to keep only a small fraction of reserves. The rest can be created through lending. For example, if reserve requirements are 10%, a bank can lend many times more than it actually holds. This expands money across the entire economy. One loan becomes someone else's deposit. That deposit becomes another loan. The cycle repeats again and again. This is called the money multiplier effect. A small amount of base money supports a massive money supply. Most of it exists only as debt. Central banks support this system. They provide liquidity when banks need it. They act as lenders of last resort. When interest rates are low, banks lend aggressively. The money supply expands rapidly. Asset prices begin to rise across the economy. When interest rates rise, lending slows down. Money creation starts to contract. This is when financial stress appears. This is why recessions feel like money is disappearing. Loans are repaid or they default. Money created earlier is quietly destroyed. Yes, money can be destroyed. When loans are fully paid back, that money vanishes from the system. It returns to nothing. This explains why debt is essential to modern economies. Without new debt, there is no new money. Economic growth becomes impossible. Governments also depend on this system. They borrow from banks and financial markets. That borrowing creates even more money. National debt is not just government spending. It is a powerful mechanism of money creation. The system requires continuous expansion. The problem is interest. Banks create the principal but not the interest. That extra money must come from somewhere. This creates permanent pressure to borrow more. New debt is required to pay old interest. The cycle never truly ends. Those closest to the money creation process benefit first. Banks, financial institutions, and asset holders gain early. Ordinary people receive money later after inflation has already risen. This effect is known as the Cantillon effect. It quietly transfers wealth upward without anyone voting for it. Inflation is not just rising prices, it is the dilution of purchasing power. More money is chasing the same limited goods. Savings slowly lose value over time. Debt holders often benefit instead. This reshapes society in subtle but powerful ways. Understanding this changes how you see money. Banks are not just intermediaries between savers and borrowers, they are active money creators. Money is not scarce by nature, it is limited by policy, regulation, and control, and by who is allowed to create it. This system is powerful but also fragile. It depends entirely on confidence and trust. When trust breaks, everything begins to shake. Bank runs, financial crashes, and massive bailouts come from this structure. Governments step in to save the system, because without it, money stops flowing. Once you see this, you cannot unsee it. Money is not what you were taught in school, it is a system of controlled credit. The real question is not how money is created. The real question is who controls its creation and who ultimately pays the price.